This is PropertyBT, a podcast of BT correspondents.
Around once every 5 years, Singaporeans vote in general elections for members of parliament. The recently concluded GE 2025 saw Prime Minister Lawrence Wong lead the People's Action Party or PAP to return to power with a clear mandate to face the challenges of a troubled world. The US is erecting trade barriers. Superpowers the US and China are locked in intense competition. Many economists worry over the outlook for the global economy. Amid rough economic conditions, can office and industrial properties in Singapore prove resilient? Welcome to PropertyBT. I'm Leslie Yee, Senior Correspondent of the Business Times. My guest today is Xian, Head of Research Singapore and Southeast Asia at Cushman and Wakefield. Welcome, Xian.
Thank you, Leslie.
I'm not sure if you followed GE 2025 with all its colour and excitement as closely as many of us in the media did. Now there's a new term of government, and the external environment looks tough. What is your outlook for the Singapore economy and policies affecting businesses in the new term of government?
So post-elections, I think businesses will appreciate the stability and predictability that's expected to continue, especially amidst all the uncertainty globally. So I'm cautiously optimistic about Singapore's economic outlook. While Singapore will not be immune to a global economic slowdown, it's good to note a few things. One, the Singapore economy was entering 2025 on a fairly good footing. We saw strong GDP growth, unemployment was low, wages were growing, and domestic consumption was quite steady. Inflation and interest rates as well were on a downward trend. But that said, the level of uncertainty in the global economy remains high, and the longer this uncertainty drags out, this will be more damaging to the global economy. And Singapore is not immune to this. The waters are rough, but luckily we have invested and upgraded our sampan over the last few years, and hopefully we can stay afloat in these rough waters.
I'm not sure how effective sampans are to stay afloat in rough waters. But yeah, I suppose a slowing economy will present challenges for businesses and individuals. Xian, from past experiences, which property asset segments perform relatively better and which are hardest hit in the event of a recession?
The first sectors that you'll see hit is typically the commercial sectors, so your offices, industrial, but each recession is different. During the global financial crisis, definitely it was the offices that got the worst impact because of the impact to the financial sector. During the pandemic, even though GDP growth came down sharply, but you look at logistics, that really saw a huge boom. So I would say every recession is different. We really have to look at what are the underlying factors.
Xian, if we zero in on the economic weakness that we may be looking at with trade uncertainties, is Singapore still attractive for new businesses to set up shop and existing ones to grow their footprints? And will demand for, say, the office, factory, warehouse space get affected with these rising trade tensions?
Yeah, so I think Singapore is still attractive for new businesses to set up shop and expand footprints. There are several factors that make Singapore attractive across sectors like finance, technology, high-value manufacturing. Some of these factors include our deep pool of skilled labour, developed infrastructure, very importantly, the strong ecosystem of world-class companies that are all based in Singapore. Singapore has one of the most extensive free trade agreements across the world, and our strategic location in Asia Pacific. So this also helps underpin both our services and manufacturing sectors as well.
One way we're also mitigating all this is to build closer ties with our neighbours, for example, with the Johor-Singapore Special Economic Zone or JSSEZ. Do you think this will make Singapore less attractive for businesses, and will we see demand for industrial space here impacted by the JSSEZ?
I think it really depends. Companies that want to take advantage of Singapore's strong business ecosystem, they'll be still attracted to come over to Singapore, while they can also still leverage on lower costs in Malaysia. So I think this could potentially attract actually new demand coming to Singapore, especially when we hear, in the region, there's still that trend of supply chain diversification. In terms of the industrial sector, whether some companies might move over to Malaysia, I would say this trend is not something new. Over the last decade, companies that are land-intensive, labor-intensive, we tend to find operating costs in Singapore, it has gone up over the last few years. But if you are capital intensive or you're looking to set up an automated factory, Singapore still is really appealing.
Interesting. So hopefully there's some complementarity and that both Johor and Singapore have something to offer to businesses. Let's now zoom in on the office property market here. This segment has done well post-COVID pandemic. Many companies have their staff now largely working out of physical offices and not remotely. At the same time, businesses from diverse sectors have been growing their presence here. Xian, so from your colleagues on the leasing side, what has momentum been like in terms of new leasing inquiries in the office market here?
I think in terms of leasing activities, that has slowed. Some deals are still being done, but for those that are in early stages of discussion, some deals have been put on hold, which is not surprising because given how tariffs could change overnight, you can't project how your business will grow. You're definitely not going to make any capex decisions in the near term.
And what is your outlook for different segments of the Singapore office rental market over the next couple of years?
If you look at CBD Grade A office rents, that still remains stable and it still managed to show some slight growth in the first quarter of this year. And vacancy rates remain low at about 5 to 6%. And this is still one of the lowest vacancy rates for an office market in Asia Pacific. In decentralized locations where rents are lower, vacancy rates are also under 10%. So I think generally, Singapore office markets, they have displayed quite remarkable resilience. I think there are a few key reasons for this. One, new office supply, particularly in the CBD, remains fairly constrained. Over the last few years, quite a fair bit comes from redevelopments rather than new supply from the government land sales. And looking forward, the supply pipeline will tighten. You're going to see annual net supply from 2025 to 2027 average to only about 0.4 million square feet per year.
So you still expect some growth in office rents over the rest of this year into next year? And are you more positive on CBD Grade A versus other segments in the market?
Definitely, the current uncertainty will continue to lead to a delay in decision making. So we could see more renewals rather than relocations. Occupancy will still remain fairly high, right? So that helps to support rental growth. We may not see very strong rental growth this year. The economy is slowing down. There's still a lot of uncertainty, but rents could potentially grow 2 to 3%. So definitely, I think we'll see this positive impact come to the CBD first. But as rents in the CBD rise, right, you'll see spillover effects move over to the decentralized office markets as well.
Still to come, how will the trade war affect industrial properties? Also, will Singapore's political stability protect the local property market from headwinds? That's after the break.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Clarissa Montero in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to PropertyBT, a podcast of BT correspondents.
Welcome back to PropertyBT. I'm Leslie Yee. As an asset class, industrial properties in Singapore have shown great resilience. But this segment could be particularly hard hit by trade tariffs. Xian, as global trade gets weighed down by uncertainty, how do you see rental performance in different segments of industrial and logistics properties?
So right now, I think the impact of higher trade tariffs may not be fully reflected in data, and we could also see some front-loading of demand due to the pause on reciprocal tariffs. As of Q1 2025, we saw slight rental growth across most sectors in the industrial market, but definitely I think in terms of leasing activities, we are seeing some occupiers take a watch-and-wait approach. But interestingly, we also saw a lot of inquiries when reciprocal tariffs first came out, because I think Singapore had one of the lowest tariffs in Southeast Asia. Whether it translates to demand is still uncertain. I think we still need to wait to see how that evolves. While things remain uncertain, there are a few things to also note. With the recent de-escalation in trade tensions between the US and China, I think the probability of a global economic recession has probably come down significantly. And also the trends of supply chain diversification. This is expected to continue, and this would support demand for Singapore logistics. Another thing to also consider is that Asia Pacific is still expected to be one of the fastest growing regions in the world. We are underpinned by China, India, Indonesia, which are really huge economies. So that also bodes well for the whole APEC supply chain ecosystem. So I still anticipate steady growth for industrial rents over the next few years.
We have talked about demand among space users for office, industrial and logistics properties. Perhaps now let's look at the demand for such properties in the investment sales market. Xian, do you think investment activity will slow down for office and industrial properties?
Not surprising with all the uncertainty right now, I think some investors are adopting a watch and wait approach, and this would have an impact on investment volumes in 2025. But encouragingly, there was really strong investment momentum building into 2025 with a strong growth in 2024 investment sales volumes and drivers such as lower interest rates, good supply-demand dynamics, a stable Singapore dollar. These factors, I don't think they have changed. Given current uncertainty, potentially they may be pent-up demand building. And once this passes, when things are a bit more clearer, investment volumes could rebound, maybe towards the end of 2025.
Still, given potential weakening in demand among space users, I wonder how the capital values of office, industrial and logistics properties here will fare over the near to medium term. Xian, how do you think the economic uncertainty will weigh on capital values in the coming years?
Actually, capital values, despite high interest rates over the last few years, they have not really moved. So actually, there was hardly any repricing in Singapore markets. So it really shows the resilience of Singapore property. This is because the predictability of the cash flows. Occupancy rates across most assets are fairly high. CBD Grade A offices, occupancy rates are 95%, which is one of the highest in Asia Pacific.
So generally, you think capital values of office, industrial, logistics properties still continue to hold and possibly even appreciate? Would that be correct?
Oh, yes. So barring a steep economic recession, right, which would impact demand, the trends of lower interest rates would definitely, provide a boost to capital values over time.
At the start, we talked about GE 2025. The PAP has been dominant in Singapore throughout 60 years of the nation's independence. Xian, do foreign investors view the PAP's dominance as a major plus for Singapore property?
I think foreign investors will appreciate the stability. Really, investors, they still view Singapore as a safe haven, clear regulations, stable currency, transparent market, and also a predictable supply pipeline for property, typically. While property yields in Singapore may not be very high, it can act as a good stabilizer for the investor portfolio. On the other hand, because of this stability, prices in Singapore have not really moved much. So this has also had an impact on transaction volumes. So some institutional investors, they may decide to look at other markets where, prices have corrected significantly, in hopes for a better deal.
With huge trade uncertainties and hot superpower rivalry, the world economy is facing turbulence. Challenges loom for office, industrial and logistics properties here. Still, if Singapore can continue to make a good living in a troubled world, these properties will find appeal among space users and investors. Thank you to my guest, Wong Xian of Cushman and Wakefield.
Thank you, Leslie.
That's it for PropertyBT this time. Happy property hunting. Next week, BT correspondents will be back with an all-new episode on markets. So do subscribe to our channel and check it out. If you have any thoughts or questions about the show, email us at btpodcast@sph.com.sg. I'm Leslie Yee. As always, thank you for listening. See you next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.